Like what we're watching with Wells Fargo. It takes time to kind of come out and understand all the dynamics and what this means. It's really a shifting landscape with how this foreign business has to operate. So I think there is going to be a transition. I think there will be some fines and some give back of fees that we'll have to see. And that will just be an overhang for that stock for the time being. So I think it's a wait and see. You got to watch that kind of percolate on its own path.
Do you think that impacts the rest of their business? Meaning, do you think that if you were a potential Goldman client or somebody else who was thinking about retaining them for whatever reason, given this mix of headlines, that somebody would say, you know what, actually, we're going to use so-and-so instead right now?
I think that there's marginally, there's probably, like we saw Wells Fargo, some impact there, but I don't think that it's broad-based. I think there's reasons why customers use Goldman Sachs versus others, and I think that franchise value is still going to be there. So I don't think there's a broad movement. I think there'll be incremental deals that might, in the short run, move one place to another, but I don't think in the long run that will damage the franchise we're looking at here.
Well, by the way, what do you think of this Goldman Sachs news?
I'm going to stay. I don't have a dog in this fight.
Right.
I'm just going to stay out of it. I mean, I do remember very well, a million years ago, Gus Levy took me up to his apartment here in New York, and he said, when we go public, it's a totally different culture. Everything changes, Richard. And he was actually given his old style,
right,
having been one of the people that built that firm. He was quite worried about the kind of pressures it would put on the partners over time. And I think he's proven right.
And you think that's bearing fruit? Do you think that's true of all public? Okay, that raises a different question. Do you think that all of these banks shouldn't be public?
I'm not saying that. I mean,
right.
Again, I came out of a great private bank, Brown Brothers Harriman Company, a little bitty bank, but it's always had a different kind of culture. When your own money's at risk, you take different kinds of risks. But no, there's some great institutions out there. And I would say the greatest, of course, you've got Morgan, you have Barclays, right, and you have good institutions.
Right. Hey, Marty,
because they need to be. And, you know, they're going to suffer the whims and whatever of being a publicly held company. Right. It's the way it works.
Hey, Marty, we got to run, but is there any of the banks that you would actually stay away from right now in this environment?
Well, again, it's going to be your prescription of risk. If you really believe that we need to hunker down because we're going into that recession, you want to focus on the banks that are going to perform the best through that process. It's going to be the U.S. banks. It's going to be the M&T banks. But if you feel like that we're going to be at least in this kind of stagnant, slow growth environment, with the chance to see upside when there are some catalysts, then these super regional banks in good areas like a SunTrust in the Southeast are really good.
Basically.
Yeah, that's exactly right, because we're valuation
even though they're down 10%.
Yes. Well, but because we have a credit cycle monitor that basically says, as we look over the next 12 to 18 months, we're not heading into recession. So the discount that you get right now says that stability gives you cash flow of about 10%, because these banks are being able to deploy capital, being able to generate a 3 to 4% dividend yield. Right. And when we look at that, that gives us the surety to be able to say we can buy most any bank at this point, and we're going to see upside and total return for shareholders that's going to beat the market over the next year.